We are living through the worst economy that almost anybody alive has ever seen.
Hey guys, what's up? Welcome back to The Impeccable Investor. Howard S. Marks is an American investor and writer with a net worth of $2.2 billion. The scenario in the global stock market has been pretty rocky since the pandemic, and this is what the co-founder of Oak Tree Capital Management, Howard Marks, has to say about the nature of the U.S. market amidst COVID-19. Number 1. The idea this time it's different. Marx believes that the popular notion that things will be different this time and that the situation will only get better is worrisome, if they are the ideas that are guiding investors today. Although it is always difficult to predict the timing of an economic recession, Marx says he's been confident that an economic downturn is on the horizon at some point. After all, economic cycles exist pertaining that after a flavorful period of boom, there will be a period of bust, and excess of anything in an economy is corrected through a period of negative growth. For Mark, the current recovery is bound to become the longest in U.S. history, and this will obviously cause concern towards another market crash. In short, ignorance related to the economic cycle can cause the market to crash. 2. Is prevention smart? Some people are optimistic that the Federal Reserves and other central banks are capable of postponing the recession, but Marx seems to be concerned whether postponing the recession is the right thing to do, and if we're ready to face the consequences of this delay. Marx doesn't believe that recessions are avoidable or postponable, and if postponing is an option, isn't it better for the inevitable to occur naturally instead of being postponed unnaturally? Moving on. How will the Feds postpone the recession? Will they have a series of small recessions? Wouldn't that mean once the ability of the people to keep doing so reaches its limit, and when the recession following this capacity will arrive, it will be catastrophic? Similarly, if another market crash is to hit us, isn't it better to let it arrive naturally rather than digging another hole of danger for ourselves by trying to postpone it? Number 3. Federal Reserves. The Feds have been buying corporate debt and injecting money into the stock market, which is why the 35% decrease in the market during March has now relatively recovered. Mark predicts that these artificially supported markets will eventually fall, and when they do, there will be no Federal Reserves or capital banks which will be able to fight/delay the crash, resulting in greater damage for the people. Number 4. Over-optimism. Mark says that crash cycles can be different in nature, but most of them carry the same themes and characteristics. He has witnessed over a dozen cycles in his lifetime and has seen a pattern of over-optimism during booms that result in a market crash/recession. He feels the case has been similar recently, with people propagating that there doesn't have to be another crash, and the Fed's trying to postpone the recession. Marx is worried that we may face another market crash very soon if people fail to look outside of their optimism glasses. This is because people start to take the economic cycle as an illusion, and they feel maybe we will only go upwards from now on. He also lists other characteristics that are displayed before a recession cycle: too little risk aversion, too much money in the hands of people who are too eager to put it to work. Number 5. Pump and dump. This is a classic scenario that causes markets to crash, and according to Mark, it is currently happening with tech companies. People have benefited by investing in tech companies since the past decade, and they feel it will keep being profitable for them even in such situations. Moving on, a classic case of pump and dump commences when a big party/investor starts buying a huge amount of shares in a company, which derives demand, and the demand increases, the prices by default increase even though the company hasn't made any efforts for such an outcome. Eventually, the company becomes overvalued, and the big party/investor now decides to sell off all their shares, causing the supply to increase, and once the shares are in abundance in the market, the prices will drop, causing the market to crash. In such cases, the first person to sell off the shares profits the most, and the rest of the suppliers have to face heavy repercussions. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.